Hello, everyone, and welcome to today's Strategic Source webinar. The topic, like you see on the screen, is deferring capital gains with a deferred sales trust. And our CEO here at Strategic Source, Doug Austin, will come on for his opening comments before he introduces today's guest speaker. There's a Q&A box in the lower right-hand corner of your screen. There's a little box at the bottom of that. You can type in a question at any point, and we'll try to answer as many of those as we can during this 60-minute session. So let's get underway. Doug, you can go ahead and begin your webcam. Here now is Doug Austin, CEO of Strategic Source.
Well, welcome everybody. We're glad you joined in today. This is yet another of the innovative webinar series. Our intent is to provide innovative ideas and suppliers that can help you to address expense categories, audit and recovery categories, and new revenue opportunities. We have done a number of these already since June. They are located, the recorded webinars are located on our website if you want to check that and see what those opportunities are. Today we've got a real interesting opportunity for dealer principals, the deferring capital gains with a deferred sales trust. I was introduced to Richard Rogers a number of months ago at a session in Miami, and Richard has got access to a number of interesting tax deferral ideas, and he's invited Michael McIntyre to speak today. So with that, I'm going to turn it over to Richard. At the end of it, we'll have a little bit of Q&A and then some information on Strategic Source, but I'd encourage you to get your questions in if you have any, and we'll have some give and take as this session proceeds. So thanks very much for attending. Richard, it's all yours.
Thank you, Doug. My name is Richard Rogers. I'm with Dana Investment Group. At Dana, we focus on tax, investment, and insurance strategies. One of those strategies includes deferring capital gains, including deferring capital gains on the sale of your business, and for the auto industry specifically, distributions from your reinsurance companies. Today, we have Michael McIntyre, the National Training Director for the Estate Planning Team. The Estate Planning Team is who created the Deferred Sales Trust. So Michael is going to take us through the webinar today. So Michael, are you there?
I am. Greetings, everybody. Hope everybody's well. My name is Michael McIntyre. My job is to teach you our strategy called the Deferred Sales Trust. Our strategy has been around for about 26 years, and hopefully we can talk to you about deferring our structure. The name of our structure is called Deferring, the Deferred Sales Trust. And as the name would imply, we're going to defer a gain, any kind of gain that you have on the sale of any kind of highly appreciated assets. And any type of highly appreciated assets, which is real estate, a business, even your captive itself that you might have, that you have as a auto dealer. This is why a lot of times businesses don't sell. They don't sell because of capital gains. There's a lot of different solutions that are out there to defer the gain, defer it. As the name implied, estate planning team, we were started about 24 years ago. The structure itself is 26 years ago. We trademarked the name. We are a law firm, accounting firm, and marketing organization that we basically provide this solution to deferring capital gains. And we have two structures that we're going to talk about. Today, we're going to talk about the Deferred Sales Trust, which we trademarked, and the DST Plus. Between the two, they can defer just about any capital gain in any size that you might have. Well, our structure, like I said, it's been around for a while. We're going to unpack a transaction now on how it works. We're going to defer a gain here. We're going to have a wash transaction for the trust, and then an annual wash on the trust itself and we're going to freeze the capital gains. So you could have, like I said, you could have any asset that you are selling. Could be real estate, could be a business, could even be a collectible. Rare cars we've done, Bitcoin, stocks, individual stocks that are publicly traded, privately traded. If you name it, we've probably done it. This year, we're fortunate that we think we'll do over $3 billion of deals this year. And we're probably the best secret maybe you've never heard of, because we only work through trained advisors like Richard. And that's all we do. We don't want this message to be messed up and screwed up in front of the IRS, because you don't want to poke that bear. And we've been through a few audits, we've been through things, and we are peer-tested, peer-reviewed by other outside law firms itself. So we can get into all of that in just a minute. Let's just unpack a transaction right now. What we have is a seller who's got this highly appreciated property, and the trustee who's right here, this third-party trustee, number 2, is going to curate the trust. If this is you and you're selling it, perhaps you put your own name on it, you name the trust. There's no commingling of any of these trusts. Each trust is individually done. And our law firm is, you're going to engage, if you're the seller, you will have an engagement agreement. It's a limited engagement agreement. You only pay for the services if you complete it and you're happy with the transaction. So no retainer, no upfront for the transaction. Now the trust now exists, and it has its own tax ID number, and just prior to the sale, this trust is formed, and prior to what is called constructive receipt. We're avoiding this constructive receipt. We're freezing it for a period of time. How long can you do it? As long as you want. That's kind of my favorite answer here. We basically sell the asset or assignment or the defeasance agreement to the trust itself. And the trust is then, it has now the asset for maybe a New York minute, and it sells it to the buyer. We need, as the name implies, deferred sales trust, we need to have a buyer in order for it to happen. But we're basically taking taxes off the table for the seller. And they turn to Richard and say, invest my money, invest it, and make a return. And now you might have 24 to 40 or 50% more of your money working for you. So your income's going to be quite a bit bigger. And then when you receive the funds, you now have constructive receipt. You could have principal payments, interest payments, all of that. I went a little too fast there. Sorry about that. There's apparently a little latency in the button here. Let's go back. Wow. And so the structure itself defers the gain, and you get to invest the funds. The income that you receive on it, if it's over, let's say it's $5 million is the sale. That's an easy number. And the sale over $5 million is any type of income that you have on it over above the $5 million is ordinary income. The principal, we've frozen the capital gains treatment to it. And that freezing allows you to defer it as long as you want to keep it frozen. If you decide that you want to take income or principal from it, you'll pay taxes on the time when you receive it as a consumer. So as long as you want to not be a consumer on any of that money, you'll pay a lower tax rate on it. And where our tax structure works, obviously it's progressive. So the more money that you take in, the higher your taxes are. So if you can keep this money as a reservoir, if you wish, on a few different ways. One, you just spend less money and defer it as much as you want. You can defer the income. You can defer the principal. People ask, well, what kind of payments can I take? And it's my favorite answer, which is, what would you like? How would you like those payments? How often do you want those payments? What's the frequency? Do you want to take the principal? Do you want to defer the principal? Do you want to defer the income? All of those things, because you, as the client, are now changing your title from wearing the hat of an owner of an asset to being the lender. and you've done an installment sale on this. This is IRC 453. That law is 90 years old. You're resting the structure on a 90-year-old law under a deferred sales trust. So it's very stable ground, very well-settled law that we work off of, and we follow the law perfectly. We've had over the years copycats, others, they're out of business, many of them out of business now, and our structure remains and is bigger and better than ever before. One of the questions that we get asked is something called defalcation risk. As in accounting, some point in accounting you go into forensic accounting and you uncover how fraud happens and it usually will happen where the client, one of these things are present where you didn't authorize it, the transaction, you didn't have transparency, you didn't have checks and balances on it. All of that is solved with our structure. You have to sign for everything under a system called DACA, and DACA stands for Deposit Account Control Agreement. This is where a third-party bank acts as a signator on all of your transactions, making sure that it's you that signed and that the trustee also signed. So you have to authorize all of the investments. It's going to be held with Richard. It's going to be held at either Pershing or TD, where he clears and has money there. And that's a third party, and then you'll see that transaction. And so that's an important feature that you have, is that you're going to have this benefit of having authorization on all transactions, and a bank will be verifying it. It won't just be with the trustee itself. Okay, so that's a very important feature. The biggest thing, is this problem of taxation, which does not appear that it's going to get better for you if you're selling. There's a fair amount of, FUD out there, fear, uncertainty, doubt on taxation right now. Will it go up? And right now, the federal tax rate on capital gains over about $500,000 for couples is 20%. And then I'm showing state of California at 13. And you might say that's an outlier since you're not your situs is not, California, either for the real estate or you personally. But what if federal taxes go up to 33.3? There's a proposal right now for it to be at 43.8 with the Medicare tax at 3.8 to make it ordinary income and to have it go retroactively back to April. But I don't think that will happen, but I think there's going to be some push and some compromise that will increase taxes. That being said, this number here would hold true. Now, you might say, well, why not just pay the tax today because taxes are going to go up? Well, you don't know if taxes are going to go up, and you've missed out on a huge time value of money equation. This $1.5 million could be working for you. Anybody want to loan me $1.5 million interest-free? Because I'm willing to do that right now. And that's essentially what you're doing with the IRS, is that you're able to earn money on an interest-free loan right now. And even if taxes were to go up, the ability for you to earn interest on your money with a great advisor, here that you have Richard Rogers to go invest for you, it's so important for you. It's being a good steward of your money itself. So I guess we've got a couple poll questions here that we're going to go to. And let's see. Now, one of the questions, I guess, is why hasn't my CPA suggested doing this? Well, we don't, I think there's always a misunderstanding of a CPA. As an accountant, I always, being in accounting, you feel like, have you ever seen that I Love Lucy video where she's working and the assembly line, I think it's a chocolate factory, and she's just trying to keep up with it, and it gets all bad? That's the way you feel as an accountant, because you're basically trying to be a really good scorekeeper for all the massive IRS rules, and you're trying to put it into your software system. You're trying to do that. Just maintaining and being a scorekeeper for most CPAs, they don't have the time to really look at some of the solutions. And you're taught to look at them carefully, and the due diligence period to actually look at it is there. We do offer 2 hours of continuing education that we've put together now for CPAs, and we do that, and we do have a lot of members of CPAs, and we will work collaboratively with your CPA. Second question I see, which is, do I lose control of my money? Well, I think if, to be a little sarcastic, I think you lose about $1.5 million in that previous explanation, that previous demonstration. That's about as permanent of a loss that I could think of. You do get to make investment choices. Think of it like I said earlier, like a self-directed IRA. And as a self-directed IRA, you make all the same suitable choices that you would for that. The only difference is on a self-directed IRA, there's a bit of exigency for you at 72.5 where you have to start liquidating this. And you can't really give it ultimately to your children, and it's going to be ordinary income tax on it, which this will be capital gains on the proportion amounts. That's super important to you. So poll questions. Where are the poll questions? Here. Gotcha. Okay. Have you ever paid capital gains taxes? Those are, I guess, the poll one. Yeah, I guess. So we have 100% that everybody said that they pay capital gains taxes right there. Would you list your business if you knew you had other options? Nobody voted on that right there. So, 100% now. Yeah, so 100%. We're getting a good turnout here of 100% on the elections here that we're having. Let's go to the next one here. And one of the challenges on the 1031 is that it's really under some pressure now by both states and by the federal government. There's kind of a squeeze going on. At the same time that these legislative changes and changes are happening, we've had a little thing called a pandemic in the last year and a half, and it's really put some challenges on real estate. Certain types of real estate are just unwanted. Multifamily is difficult if you can't evict people. Hospitality is a difficult venture right now with restaurants, and probably going into another round of lockdowns. So all of these things are hard, but one of the biggest things that's ever present is the short time frame to do a 1031. You've got 45 days to identify and 180 days to close the transaction. Some people say, well, you could do a reverse 1031, but if you do too much of a reverse, then it's invalid. So the 1031 is difficult. It's kind of that shotgun wedding purchases of real estate. It is difficult. Now, several states now, including the state I'm in California, actually withhold or tax your money on the 1031. Government sees a big ticket item, they know that with a step-up in basis, they may never get. So DEF allows a 1031 to avoid 100% of taxes. So states don't like that. They like big tickets. They like taxing those big tickets. They want to do that. And
Michael,
there are several. Yeah.
Michael, listen, could you just, at a 50,000-foot level, can you just define what a 1031 is?
1031 is an exchange from real estate to real estate. It used to be a 1031 applied to collectibles, it could apply to businesses, but now it's only real estate. And it's got to be kind of a like-to-like type of transaction in which you can exchange it from one property to another property with a 45-day identification period and 180 days to close. You must close it in that period of time. It's held at a QI, a qualified intermediary, and it's only for real estate. It will not apply to your business if you're selling your business. Some of the negatives to that are this depreciation recapture punt that you get, and all of these states that we have a latency issue here, I guess, with these slides here. I'm clicking them, and then a minute later it moves. So here are the 1031s that these are the states that presently either tax or withhold money on a 1031. And so some of them are mild with 3%, some of them 5 and 10% on their taxes. Some of them have nasty clawbacks in them. And all of this means that if you have to do a like exchange, you got to purchase it for the same or greater value. But if you're missing 3 to 10% of your money, how do you do that transaction? I'm not sure exactly how you do that. So that winds up being a pretty big challenge that you have in doing a 1031, particularly since there are states that are going to tax the 1031, like Pennsylvania fully, California, New York, and New Jersey all have pending legislations to fully tax the 1031s. They're having negative populations, just like Pennsylvania does, and so the move is to fully tax it or to cut it. The federal government at $500,000 has made a proposal on the latest tax proposal to tax the 1031 when your AGI, your adjusted gross income, is over $500,000, to take away the step up in basis away as well. And so that may greatly harm people with 1031s. So,
Mike again, can you give us a couple of examples without names, obviously, but can you give us a couple of examples of dealers that may have engaged in a 1031 and why they would do so?
We usually they usually have done deferred sales trust in lieu of the 1031, but you might want to do a 1031 if you still wanted to stay as a dealer and you wanted to move your location and you still wanted to stay as an auto dealer. But if you were exiting or you didn't want to own the real estate, we've worked on a number of auto dealers over the years where they either want to not own the real estate anymore, relocate, and it would be cheaper on the relocation, and they had excess funds, so they couldn't fully do the equal or greater value rule. So those are all different reasons why people would do the deferred sales trust in lieu of a 1031. How do we know it's legal? Well, we've been doing it a long time. We are reviewed and audited by the IRS about every 10 years. It seems that we've been audited by the IRS directly. We've been reviewed by the authority that is a self-regulating organization that reviews Richard's ethics and all financial advisors and finance, called FINRA. And we also are peer-reviewed by a number of national law firms that now have extended to clients the ability for them to have a legal opinion. It's additional money to go through. You pay that law firm. The law firm owns the property of their opinion letter. So we don't release their opinion letter. It is their opinion letter. But what most clients do is they rely off of an audit defense that we provide, our lawyers do, and our lawyers will defend you in the event of any audit. We've had 14 clients over time have been audited. We were not the trigger for the audit. I want to make that very, very clear. We were not the reason for the audit. They were audited for another reason entirely, but we defend that, and we do that to defend it. Anytime any client is ever audited, it's kind of like a warranty that you're getting here on the representation. There's no additional fee for that audit defense. So clients are pretty happy with that. So minimum terms that we'll do on a transaction where I think it has efficacy is about a $500,000 deal. It makes sense. If it's a cumulative $500,000, that's that's also something to think about is that if there's a series of sales that accumulate to $500,000, we'll do those. Usually our average deal is probably around $4 million is I think our average deal that we're doing. And how long can you defer it? So you can defer up to a 10-year period of time, but then you can renew that at the end of the 10th year itself. So that is a powerful tool that you have. So eventually, if you pass away, you put your promissory note, your installment note in your living trust or in your estate, and then they would have it. They would have the deferral. The children could continue to defer that tax. I'm getting a pretty bad latency on, so I skipped over the fees here. And
yeah, can you back up, Richard? I think that was an interesting chart. We'd like to see that.
Yeah. Can somebody? I'm having a terrible latency. I click on it and nothing happens, and then so here we go. Is somebody else controlling it? Looks like somebody else is controlling it.
Doug.
Okay. So we went over this slide, and we want to go to the fee schedule, I believe. So we charge 1.5% on the first million itself, and that's on the gross or the net proceeds of a transaction. So if that was debt or the sell price, it might, depending upon the size of the transaction, on the smallest of accounts, it's 1.5% of the first million, 1.25% on the second million, and a flat 1% over 8 million. We household, so if there was a family in the transaction, we can possibly household to the smaller amount there. And that covers the legal and the tax structure there. There's some ongoing fees. If we could go to that, the ongoing fees would be about 85 basis points on the transaction. We're going all over the map on these slides here. It's 85 basis points on the structure ongoing. There's about $1,000 for a tax return on it each year. And then the advisor fees, we generally are about 65 basis points each year. So the clients on the smallest of accounts are about 150 basis points or 1.5%. So that number, that percentage obviously goes down as the transaction goes up. So if you have questions about a potential deal, we can certainly source that and give you an estimate of what those costs might be. But it's certainly cheaper than paying the IRS.
Michael, this is Richard. I think it's important to discuss, when are the attorney fees paid? Is that paid in advance, or can you talk about that a little bit?
Yeah, the legal fees are charged 1.5%, 1.25%, not on a retainer basis, but on a contingency basis. So if the deal happens, and sometimes deals don't happen, you pay nothing as the seller. You only pay, like I said earlier, you're only going to pay if you're happy and you're satisfied and your money is placed. So it gets withdrawn with your authorization as the seller in the transaction at the proceeds. So that's how you pay for the legal fee. So if the deal, like I said, the deal doesn't happen, or you don't want the deal to happen, or you don't want to deal with us, your cost is nothing to us. So that's a pretty fair deal. And then when you do the transaction, remember that you're represented in the event of an audit. So pretty rare that in a law firm, I've never heard of this before, maybe you have, where a law firm will do everything on contingency, no retainer up front, and be represented at the conclusion. And you have to be happy with the transaction as it goes.
Mike, this is Doug. Obviously, I'm not a CPA, and this is interesting and potentially compelling. What is the bottom line benefit that a dealer would see going through this process? And I realize that there are a number of dealers and a number of different scenarios, but what could a dealer expect to see as the benefit, either in tax deferrals or cash up front? What can they expect?
Yeah, I think if you're in a state like Texas, you're going to save yourself about 24% in taxes. And in a state like California, you're going to save yourself 40% in taxes by deferring it. And the money that you would invest, the return, think of it like in that previous example where we have the $5 million on the transaction, you're going to be able to defer the tax. Think of it like a tax, an interest-free loan by the government. And for about 80% of our clients, they follow kind of a tune of getting out of the business that they're in, retiring, financial independence, and it just doesn't make sense to lose 24 to 40% of your money on day one of any kind of stewardship. So if you expect to have the same lifestyle, what many of our dealer sellers have told me is that they just didn't see any other way of maintaining their lifestyle in any shape or form by losing 24 to 40% of their money on day one. So hopefully that makes sense. Also, we'll go into that you can actually use the structure to purchase additional real estate or another business using it. But I'm not doing very well on clicking these buttons here, so do we want to do the poll questions now? Okay, so the poll question is, has your CPA told you about this solution? No, 100%. Okay, so that's, the CPA, again, you probably would get this from a tax attorney. More than likely, our structure, we're known from the tax attorneys, and maybe not so much on the CPA because they're, again, charged with filing the return and keeping it in good order. So if you go on to the next one, please. Do you know that you could use a deferred sales trust for distributions from a producer-owned reinsurance company to defer your capital gain? No, 100%. So that is the captive insurance, as you call it in the, I called it earlier a captive. So sometimes the captives run out of their usefulness where you folded it and maybe you're going to use it. It's essentially the retained earnings, your what you have in there in your captive, your reserves. Those reserves are subject to capital gains if you dismantle the captive, the 831B, or as you call it, producer-owned reinsurance company. And as your warranties or things end, whatever they might be, where there's no more insurability or no more reason for it, perhaps it's time that you fold that up, or you're contemplating selling it, we can defer the capital gain on the reserves for that entity. So you can also buy with our structure, you could buy another business with it as well. Did you know you could defer capital gains? Okay, do we have another poll, or are we going to move on to the next? The other thing that you could do as a seller is that you can buy another business with the proceeds of your deferred sales trust. So here's an example where a client wanted to use his proceeds from the sale to buy perhaps another dealership, some raw land, a business, whatever it might be. And this is you in the blue as the seller. In the orange is your trust that you've already funded. It has millions of dollars in it, and it decides, in this case, it could take up to it takes a preferred relationship with this new co-LLC where the situs would be. So this is maybe a little more complicated than most clients want to be, but this is a great way for you to repurchase real estate or buy another business, buy another dealership, buy a great opportunity. And we see clients who do this. And the LLC is formed and the trust has a preferred relationship, which means that 100% of its capital invested, its CapEx, gets returned back before you, as the seller, would participate in the upside. So you as the seller could get 99% of the depreciation on it. You get 80% of the upside, and your trust that you have would get all of its capital back first and then have a carried interest of 20% so to maintain the loan. So all of that is able to be done pre-tax, you see? So this is a pre-tax transaction, and it reconstitutes your depreciation schedule. So on a 1031, if you're to do a 1031, it does not qualify as a new purchase. If you've used up all your depreciation, you're done. With this, we can reconstitute the depreciation, and that's important because that not only may shelter the income from the LLC cash flow to you as the managing member. That's what you are in the blue. That's a managing member position. You're able to shelter perhaps all of that income and perhaps even the income that you're getting off of the deferred sales trust. So fully sheltering that is super powerful. Doing pre-tax and fully sheltered is a powerful tool. So you don't have to rely off of a 1031. You can go well beyond the 45 days, the 180 days. You've got complete flexibility with this structure here. You could do all sorts of investments, everything under the sun that you wanted to do. You could do it in this LLC format right here. Okay? Very powerful tool. And the next thing I'm going to go to is estate taxes. I think as we all are aware, estate taxes, the exemption for estate taxes is currently $11.7 million. That will sunset in just a few years. And when it does, it's going to be cut just about in half. We're not really sure what the exact number will be. We'll find out in 2026 when all this comes to a full sunset, is that this is a problem if your estate is over, let's say, 6 or 7 million, and you're going to be taxed as an individual. Anything over the exemption, whatever that number will be 35%, and it can go up to 55%. So that's a big problem that your heirs will have for your estate. And the way we solve that, if you do the deferred sales trust, you get this hunk of money. Let's say in this particular case example, we had $20 million in the trust. And that $20 million was making the client, I believe, an overall rate of return of about 8%. I'm not making this as promissory, but they were making about $1.6 million roughly in cash flow from it. And what they wanted to do was ensure to take care or offset the estate taxes. And the policy that he qualified for cost $200,000 a year for 5 years, $1 million. And we went to a third-party lender who was willing to lend at a fixed of 3, a variable of 2. They collateralized the trust. The trust said, raised its hand and said $1 million. It's a 1-for-1. That's a pretty close to 1-for-1 is what the trust was able to just collateralize. So we're talking a small percentage, 5% of the funds were collateralized to pay for a $5 million policy, which they felt was what they wanted to pay or have outside of their estate in what's called an irrevocable life insurance trust. So if this is a brand new trust, it can't borrow any money, or no bank is really going to borrow the money, but this trust had the money, and then interest needed to be paid, which was loaned by the DST funds as a loan to the islet. So all in all, what was accomplished here is the client used the money that they would have lost to the IRS, which was about $7 million, we figured in this case. They used a small portion of that to collateralize and to pay for $5 million of estate taxes, pre-tax, and nothing out of pocket for the seller. Absolutely beautiful to pay for the estate taxes. You're literally using the government's money in a kind of a financial aikido method here to pay for your estate taxes. Absolutely beautiful here. So we like that. Hopefully that makes sense for you. If you have an estate tax concern, this is one of the least invasive ways to ever pay for life insurance itself. So it's a beautiful, beautiful plan. If you want to know more about that, this is a way to do it, is to fund this premium finance case here. Okay. So who are we? We are a estate planning team. We're a law firm, accounting firm, and marketing organization that we work with CPAs, business brokers, commercial advisors, and financial advisors make up and constitute our membership. We work with all sorts of law firms around the country, and we curate the case for you, put the case together. We have attorneys that we assign to the case, and we help you do the tax return on the trust, and the trustee, for the trustee, we curate our trustees to be assigned to your case itself. So that's who we are, and we're so happy that you could join us. We can open it up to maybe some more questions in here. Here's Richard's information. Do you have any other questions that we want to go through here before we jump off?
Sure. Thanks, everyone, for taking this in. We do have a time for Q&A with Michael. And there's the Q&A box on the left side. You can certainly ask questions, and we'll field as many of those as we can with our remaining time. And we'll have a post-session survey, too, that we would really like everyone to stay on and take just a 3-question survey as we wind up before the top of the hour.
Michael, quick question for you. What happens if the note holder passes away before the note is fully paid?
Yep. Typically, you're putting your promissory note in your living trust, and your living trust would seek out, as you would want, how avoiding probate and having designed continuity of your heirs through your living trust. Now, in some cases, people don't want it in the living trust. Maybe they're concerned about asset protection, so they would need to have an asset protection plan, and that's a state-by-state thing. Or perhaps they want it out of federal estate taxes in what's called a FLIP, a family limited partnership, which again, the ownership that you're having, your equity ownership, is in your promissory note. You don't own the trust. You own a promissory note against the trust. The trust has effectively a feckless value, Richard. It has a credit for, let's say, $5 million, but then a debt for $5 million. So it has no net worth to it. Where the net equity resides is in that promissory note. And that promissory note can be registered owned by a living trust, a FLIP, or perhaps by an asset protection entity.
Okay. And one other question, Michael. Many dealers have producer-owned reinsurance companies to reinsure their finance products. And those companies are typically controlled foreign corporations or non-controlled foreign corporations. But all of them, when distributions are paid or they close them, they pay capital gains. How do you use the deferred sales trust to defer the capital gains specifically for a captive insurance company or a producer-owned reinsurance company?
Yeah, as I was saying earlier, your reserves are considered to be, if you have constructive receipt of those, your reserves are considered to be capital gains to you if you were to receive it and dismantle the captive insurance. And so in doing so, what we do is that you can assign or sell your interest of your captive to the deferred sales trust in the same schematic that we saw earlier. So if you're ready, where there's no more insurable interest, or there's no more need for your captive, or a portion of your captive you wish to maybe harvest out, we can do that as well. We can defer the gain on that, and then you can go invest it.
Okay.
Any more questions? I don't see that.
So,
not for me.
Richard, I'm assuming that any dealer that's intrigued by this strategy today should really reach out to Richard. Richard, you'll facilitate the conversation with Michael, and I would imagine at that point it would be applicable to pull in your own CPA, the dealer's CPA, to have those conversations. Is that correct, or is that not necessary?
No, that's absolutely true. If there's anyone that is interested in talking through their scenario, they would need to reach out to me. We'll talk through that, and then, at the appropriate time, we'll introduce the law firm and Robert Binkley at the estate planning team to talk about their case. And if they're interested in talking with another dealer that I've worked with that sold their Toyota store, I'd be happy to facilitate that as well. That's using a deferred sales trust for his retirement income.
Okay. All right. Any more questions out there? It doesn't appear that there is. Okay. Well, thank you, gentlemen. I think looking at this slide again, if you've got specific questions, please reach out to Richard Rogers. And at the contact information, we can certainly provide you with a copy of the deck today. If you'd like, many of the attendees today are clients of Strategic Source. If you're not a client, if you'd like a spend assessment to better understand your opportunities to cut costs and improve profitability, certainly reach out to us. The email is sales@strategicsource.com, or reach out to Chris Austin, 612-386-3898. We're happy to help. If you're a client of ours, we'll certainly put you in touch with Richard and get the ball moving from there. Again, we have developed this series of innovative suppliers to bring new, tested, vetted ideas to our client base and to those who attend. I want to thank Richard Rogers. I want to thank Michael today for your presentation. It was very informative, and we appreciate all the information, and certainly we'll help the attendees. As David mentioned, and I'll let David close it out, we do have a quick survey at the end. We'd appreciate you to just complete that. So, David, take it away. Thank you, everybody.
All right. Thank you, Doug. Thanks for Michael McIntyre and Richard Rogers. And I have brought up the post-session survey. We'd love to get your feedback. Just 3 quick questions, as we know your time is valuable. We'd love to get your feedback on today and what you suggest for future topics. So we'll leave that up on the screen as we close. So thanks, everyone, for attending today. And we look forward to you joining us on future webinars with Strategic Source. Have a great rest of the week, everyone.